We are at the precipice of a global event that most investors are completely unprepared for. If you're watching the ticker on your screen right now and seeing silver at $77, you're looking at a mirage. You're looking at a paper reflection of a world that no longer exists. The real story isn't the price, it's the inventory. We have officially entered a stock-out alert phase. Silver isn't just getting more expensive, it is physically disappearing from the global vaults at a rate that defies historical precedent. My name is Kevin Huang, and this is Markets in Context. Today is Tuesday, December 30th, 2025, and we are witnessing the final 48 hours of the silver market as we've known it for the last 50 years. Before we dive into the catastrophic data coming out of Shanghai that the Western banks are trying to suppress, make sure you hit that subscribe button and turn on the notification bell. We are providing the only context that matters in a market defined by information warfare, and you need to be positioned before the New Year's Day lockdown takes effect. The canary in the coal mine is no longer singing. It has collapsed. To understand why silver is about to hit triple digits in January, you have to look at the Shanghai Futures Exchange, or the SHFE. For years, this has been the hub of physical silver liquidity. In January 2021, at the height of the first major retail silver squeeze, the SHFE warehouses held over 3,091 tons of physical silver. As of today, December 30th, 2025, that inventory has plummeted to a record low of just 819.431 tons. We are talking about a vertical collapse of 74% in the world's most critical industrial silver hub. But it's the velocity of this drain that should terrify you. In just the last 7 days alone, we saw nearly 33 tons simply vanish from the official records. This isn't a slow drain. This is a vacuum. China, the largest producer of solar panels and the most aggressive buyer of industrial silver on Earth, is running on fumes. When the world's primary refinery operates at a 10-year low inventory while simultaneously facing record industrial demand, the system doesn't just bend, it breaks. Why is this metal disappearing? Because the industrial giants and the smart money have realized that the paper markets in the West are a trap. On Monday, December 29th, we saw one of the most violent flash crashes in history. Silver futures on the COMEX were slammed from a record high near $84 down to a terrifying intraday minimum of $70.70. To the uneducated observer, it looked like a bubble bursting. But to those of us looking at the internal data, it was a coordinated kill switch. The CME Group issued Notice 25393, raising margin requirements by an aggressive 25%. They hiked the initial margin for a single silver contract to $25,000 practically overnight. This wasn't a market-driven sell-off, it was a regulatory hammer. This move was designed to force liquidations, hunt stop losses, and scare retail investors out of their positions just 48 hours before the landscape changes forever. It was an attempt to clear the weak hands so the banks could settle their massive short positions at a lower price. However, there is a smoking gun that proves this crash was a fabrication of the paper market. While the paper price was being smashed to $70 in New York, the physical price in China refused to follow. As of my recording today, December 30th, the spot price in the East remains in a completely different universe. While the COMEX is struggling with a dead cat bounce around $77.90, the Shanghai Gold Exchange is trading at a massive structural premium. When you convert the local prices in Shanghai using the current exchange rates, you find that the physical silver price in China is approximately $83.35 per ounce. That is a structural premium of nearly $8 per ounce over the New York price. In the history of precious metals, an arbitrage gap of this size is not just a glitch, it is an alarm. In a functioning market, traders would buy silver in London at $77 and sell it in Shanghai at $83 to pocket an easy $6 profit. But that isn't happening. Why? Because the arbitrage is broken. There is no physical metal left in the West that can be shipped to the East to close that gap. The vaults are so dry that the premium has become a permanent feature, signaling a total decoupling of physical reality from paper manipulation. This brings us to a technical phenomenon that should have every silver holder on high alert: backwardation. For those who aren't technical traders, backwardation happens when the spot price, the price for immediate delivery, is higher than the futures price. Usually, silver is in contango, meaning you pay more for delivery in 6 months to cover storage and insurance. But right now in Shanghai, the market is screaming for delivery today. Large industrial players in the East are so desperate for physical metal that they are willing to pay a premium to get it now rather than wait. They are ignoring the paper futures because they no longer trust that the metal will be there in the future. This is the ultimate sign of a stockout event. When the spot price stays $8 above the Western benchmark, the market is telling you that the real price of silver is already in the 80s, and the $70 floor established yesterday is merely a gift for those who know how to read the tape. You have to understand the gravity of the inventory collapse at 819 tons. This isn't just a number, it is a limit. China is the world's second largest exporter of silver, yet they are now operating on minimum reserves to protect their own domestic supply chain. They aren't just buying for investment anymore, they are buying for survival. The Western banks are using every tool in their shed, from margin hikes to rumored massive short dumps by shadow banks to keep the paper price suppressed. They need the price low to maintain liquidity, but they have a massive problem that no amount of paper trading can fix, the 48-hour deadline. As we sit here on December 30th, we are less than 2 days away from January 1st, 2026. This is the date that China officially implements its new export licensing regime. This isn't just red tape or a minor adjustment, it is a resource blockade. Starting Wednesday, only a handful of state-vetted companies will be allowed to move silver out of China. Beijing has figured out that the clean energy transition, the artificial intelligence revolution, and the future of defense all run on silver. By locking that supply behind a licensing wall, they are effectively weaponizing the metal. They are putting a gatekeeper between 121 million ounces of annual silver exports and the rest of the world. The message from the East is loud and clear. We need this silver for our industries, and we are no longer going to subsidize Western tech at the expense of our own reserves. This is why the $8 premium in Shanghai isn't going away. It is the sound of a trap snapping shut. While the mainstream media tries to tell you that silver is a speculative bubble because it dropped 11% on Monday, the smart money is looking at the 819-ton vault level and realizing that the supply has already snapped. The fundamentals are driving this train, and the tracks lead directly to a triple-digit silver price. For the fifth year in a row, the silver market is in a structural deficit, and 2026 is projected to be the most severe yet. Every solar panel, every electric vehicle, and every artificial intelligence server being built right now is a claim on that diminishing 819 tons. The margin hike on Monday wasn't a kill switch for the rally. It was a speed bump that merely flushed out the weak hands 48 hours before the most restrictive supply policy in history takes effect. But the supply side is only half of this nightmare. To understand why a stock out is mathematically inevitable, we have to look at the industrial black hole that is currently devouring those final 819 tons in Shanghai. We are witnessing a collision of three massive technological shifts, and each one of them is more silver hungry than the last. First, let's talk about the solar revolution. For years, the bears argued that thrifting, the process of using less silver per solar cell, would kill the demand. They were wrong. As of December 30th, 2025, the industry has shifted almost entirely to N-type cells, specifically TOPCon and HJT technology. These aren't your grandfather's solar panels. To achieve higher efficiency, these cells require between 20% and 50% more silver per watt than the older P-type technology. Despite all the talk of thrifting, the sheer volume of global installations has overwhelmed any marginal savings. In 2025, we saw record installations, and every single one of those panels is a permanent vault where silver goes to die. Because recycling silver from solar panels is currently not economically viable at $77, that metal is effectively removed from the global supply chain forever. Then we have the electric vehicle explosion. A standard internal combustion engine uses a relatively small amount of silver for its basic electronics. However, a modern electric vehicle is a rolling silver mine. According to the data in the latest strategic reports, battery electric vehicles consume between 67% and 79% more silver than traditional cars. We are talking about up to 50 grams of silver per vehicle used in battery management systems, power electronics, and high-speed charging infrastructure. With electric vehicle penetration hitting new highs in 2025, the automotive sector alone is now consuming hundreds of millions of ounces. And finally, the newest predator in the market, artificial intelligence. The massive expansion of artificial intelligence data centers is creating an unprecedented demand for high-performance computing hardware. These systems require connectors with ultra-low resistance and extreme reliability, applications where silver has no substitute. Global information technology power capacity has surged from less than 1 gigawatt in 2000 to nearly 50 gigawatts today. Every new NVIDIA chip, every network switch, and every artificial intelligence server rack is hungry for physical silver. When you combine solar, electric vehicles, and artificial intelligence, you realize that the industrial demand for silver is now inelastic. These companies must have the metal to build their products, and they will pay $100, $150, or even $200 per ounce, because the cost of the silver is still a fraction of the total product value. But without it, the production line stops. This brings us to the banking war of 2026. The disparity between the major financial institutions is at an all-time high, reflecting a total loss of consensus on where the ceiling actually is. On one side, you have the scarcity bulls. Citigroup has officially raised its 2026 outlook to $110 per ounce, citing the acute physical shortage and the breakdown of Western vaults. Goldman Sachs has labeled silver the strategic metal of the decade, predicting that the structural deficit will drive prices into triple digits as the West realizes it has been outmaneuvered by China. On the other side, you have the recession bears, like JP Morgan and Commerzbank. JP Morgan is maintaining a much more moderate, some would say delusional, target of $56 to $58, betting that a global economic slowdown will eventually temper industrial demand. They are still trading based on 1990s models that ignore the green energy transition. Commerzbank is the extreme outlier, labeling this rally a speculative bubble and forecasting a retreat back to $43. But who do you trust? The banks that are heavily short and need the price to drop to survive? Or the physical data from the Shanghai vaults? The retail consensus is already clear. 57% of private investors expect silver to trade above $100 per ounce in 2026. This is a massive psychological shift. In the past, silver investors were quick to sell at $30 or $40. Today, they are holding on with diamond hands because they see the 819-ton inventory collapse and realize that we are entering a permanent scarcity regime. Of course, we must address the black swan risks that could temporarily slow this train down. The biggest threat is technological substitution. As silver moves toward $100, the incentive to switch to galvanic copper becomes enormous. While copper is less conductive and prone to oxidation, companies like Samsung are pouring billions into silver-free battery and panel research. If a major tech giant announces a breakthrough in January, we could see a violent short-term price correction. There's also the risk of a hawkish Federal Reserve. If inflation remains sticky and the Fed is forced to keep rates higher for longer, the resulting dollar strength will be a headwind for all commodities. And then there are the geopolitical wildcards. Just this week, we saw U.S. airstrikes in Nigeria against ISIS, and tensions in the Taiwan Strait remain at a boiling point. While these events typically drive safe haven buying into silver, a total global supply chain breakage could also disrupt the very industries that use silver, creating a complex demand destruction scenario. However, as of today, December 30th, the momentum is undeniably with the bulls. The market has successfully absorbed the 15% crash from yesterday caused by the CME's margin hike. The fact that silver bounced back from $70.70 to nearly $78 in less than 24 hours is the ultimate sign of strength. It shows that the dip buyers are now more powerful than the market manipulators. We are heading into January 2026 with a perfect storm. We have the lowest global inventories in a generation. We have a superpower, China, locking its export gates in 48 hours. We have inelastic industrial demand from solar and artificial intelligence, and we have a paper market in the West that is being exposed as a hollow shell. The $8 Shanghai premium is your roadmap. It is telling you that the real price of silver is already $83.35, and the New York price is just a lagging indicator that will eventually have to play catch-up. If those 819 tons in Shanghai continue to drain in the first week of January, the stockout will move from a warning to a reality. Once the physical metal is gone, the price is no longer determined by a chart. It is determined by the highest bidder in a panic. And when Apple, Tesla, and Samsung are all bidding for the same ounce of silver, $100 will look cheap. The window to position yourself before the global silver lockdown is closing. This is a market where physical possession is everything, and paper promises are becoming increasingly worthless. My name is Kevin Huang, and this is Markets in Context. We are dedicated to bringing you the raw data and the strategic insights that the mainstream media is too afraid to touch. If you found this analysis valuable, make sure to subscribe to the channel and turn on the notification bell so you don't miss our emergency updates as the January 1st deadline hits. The next 48 hours will define the silver market for the next decade. Stay disciplined, watch the premiums, and I will see you in the next video.